In the meantime, let's talk market strategy. Joining us right now is Simeon Hyman. He's global investment strategist at ProShares Advisors, and Gabriela Santos, who is global market strategist at JP Morgan Funds. Of course, our guest host this morning is Paul Hickey. He's with Bespoke Investment Group. And Simeon, let's just say, where are you now about things? You feeling positive? You feeling like, okay, we've dodged some of the boogeymen, or are you feeling like, look out, we don't know what happens next with. We
certainly had some good economic data. We had housing starts, industrial production, retail sales. So, you know, the camp that says we might not get another Fed rate cut, I think that's growing. The news is pretty good.
Is that good news?
I think it is, because
we're not getting it because the economy's not.
Exactly. At some point, low rates are just low for the wrong reasons and not enough to support equity markets. I frankly would be a little nervous about equities if we don't have a two-handle on the 10-year early in 2020.
You agree with that, Gabriela?
I think we are still going to end up getting another rate cut.
You think that's October or December?
Maybe it will depend, but at least one more through the end of the year. And that's ultimately not because we think they should or because we think it'll really alter the economic landscape, but because the Fed didn't really push back very forcibly at all at market expectations for another cut.
Although, let me just ask about that. I mean, Steve Leisman was here yesterday saying that it sounded to him like the Fed was really trying to switch gears to say we're no longer going to be looking at all these external factors, that we really will be paying more attention to the data. If they don't do it, and that head fake is there, does the market then think, okay, none of this is ever going to happen, we'll continue to get these rate hikes with or without a weakening economy?
I think they are definitely still watching the global economy and the weakness there, but they did point to domestic factors as being very crucial as well, and that's related to business confidence, business investment, and the jobs market. Now, our expectation is that it's not a recession, but we still think business confidence and investment will stay weak. And as a result, that they'll still feel like they need to do something here, whether it's October or December.
Paul, how much of this is, do you think, the Fed cuts again and that makes markets feel good or bad, even if it's because the economy's weak? And how much of it do you think is trade talks? What would concern you more about your optimistic viewpoints?
I think, trade, an increase in trade tensions would be a factor that would hurt the markets going forward. I think as to Simeon's point, I mean, this is a pretty amazing week. Every economic indicator released this week, with the exception of Empire Manufacturing, was stronger than expected, and the Fed cut rates. So, and the market's expecting another 25 basis point cut. So, I mean, this is pretty.
But that's what I mean. If they don't get another 25 basis point cut, would that take away the optimism that you see in terms of where the market's
I think if it's because economic data is improving, that market would be able to withstand that. And throughout the last 10 years, all of the market's gains have come during periods when the 10-year yield was rising. When the 10-year yield is falling, it's a sign of, oh, shoot, things are falling apart. So I think if you look at that aspect of the market, a higher yield under 2% isn't healthy, and higher yield implies that things are getting better in the economy, and we're out of this we're evolving or moving out of this bunker mentality. So I think the trade uncertainty, everybody talks about it, and that's a big worry. Should things, deteriorate further? The question is how much of it is priced in, and I think that's up for debate among
And does
investors.
the Fed cover for any additional trade tensions by going ahead and cutting rates, even if the economy looks okay?
Yeah, I mean, I think to Gabriela's point, I think 25 basis points, we're going to get that going forward. Even if the Fed's implying that they're not going to, they've been, coming to the market's view for the last 6 months here. So, I would expect there wasn't a whole lot of pushback, again, in their comments earlier this week against a future rate cut. So I think going forward, we could easily see that happen. And if trade deteriorates further, they're going to take measures to keep things afloat.
One tricky point, perhaps, about the data this week has been that manufacturing did show slightly signs of life this week. But the issue is the first 5 months of the year, we had manufacturing contracting about 50 basis points on average a month. It's been improving the past 4 months, but only about 20 basis points a month. So by no means are we out of the woods in terms of that epicenter of the trade uncertainty affecting business confidence and manufacturing. So I think that's what's playing behind this idea that perhaps another rate cut is still in the cards.
Yeah, the opportunity here, I think, is still to be a little bit higher on the risk spectrum. I mean, look at high yield rallying more than investment grade, and look at small caps and mid caps versus large. And particularly on the equity side, that big discount on small caps is still there and very meaningful, and they react reasonably well to Fed rate cuts. So.
Why do you think the discount is there to begin with?
Well, it's been almost a similar mega cap rally that we saw in the late 90s. And we've gone from parity of price to book on small versus large 9.5 years ago to 60 cents on the dollar. That should reverse. And we've already had this month double the returns on the Russell 2000 versus the S&P 500. So I think that continues to be a trend that could be investable over the next couple of quarters.
Now, to that end, would you focus? I mean, small caps have a lot of exposure to financials and some exposure to energy. Would you be positive on those sectors as well?
I think rather than thinking about it from a sector standpoint, think about it from a leverage standpoint. I would stay away from the highly leveraged, more junkier names in small cap. 40% don't make any money because if the economy does weaken a little bit, they're a little too exposed.